Hey, hi everyone. Welcome to another video. Today, we'll go through the list of top traders in the world, and we'll go through summarize details about their strategies, their psychology, their risk management, their position sizing, discipline used by them, and how much profit they have made. Okay, so that's the topic for today. So, legendary traders and their strategies and psychology. The first one is Jesse Livermore, and he lived between 1877 and 1940. So the strategy that he used is momentum strategy and contrarian strategy. So momentum strategy is the market is bullish, you'll try to capture the momentum whenever the market is trending. You'll try to capture momentum during a trending market. That could be either a bullish market or a bearish market. You'll try to catch the momentum. So that is what a momentum strategy is, and yeah, and there is a contrarian strategy too. So contrarian is when the market is in fear, extreme fear, like Corona or housing bubble or subprime crisis. So that time, you do the opposite what the market is doing. If there is a huge selling that's happening, then you'll buy at that time. That is what is a contrarian way of strategy, basically. So those two strategies Jesse Livermore has deployed, and the momentum and contrarian strategies. He shorted during the San Francisco quake. Earthquake has happened in San Francisco, so he shorted during that quake, and also before 1929 crash. So he has shorted the markets before that events. The earthquake as well as the 1929 crash. And when you short, before the event, like a huge event happens like San Francisco quake or 1929 crash, you make a lot of money. Okay. Or before Corona, if you shorted, or during Corona, if you shorted, you'll make a lot of money. So that's how he made a lot of money. Risk management and psychology is he used pyramiding. Pyramiding is basically during the momentum strategy, as you're making money, you'll add to your position size, basically. Okay, so that's what pyramiding is. And clear stop losses he used. Psychology wise, there were emotional swings, because emotional swings will happen when you take a contrarian bet, and not everyone can go through those emotional swings when you take a contrarian bet, especially when you do over leveraging. That will put a lot of stress on you emotionally, and it will lead to repeated ruin also. So it was good from a strategy standpoint, momentum and contrarian strategy, predicting pretty much some big events, and using pyramiding and stop losses as a position sizing risk management is good. But yeah, psychology, yeah, emotional swings are there due to over leveraging. Okay. Position sizing, so scale the bets in trending moves. So that's what is pyramiding, when you scale your bets in trending moves and risked heavily during crashes. That's over leveraging. Over leveraging during crashes, that will give you a lot of money, but it will also give you, if you're right, but yeah, till you're right, you will go through a emotional roller coaster. Okay. Legacy is profited massively, but ultimately undone by poor psychological control. So he profited massively, but I think due to psychological, uh, uh, you know, poor psychological control, that was undone. That's what Jesse Livermore is. Okay. Then we have George Soros. He's famous for the British shorting the British pound. It is also called as Black Wednesday. He made a 1 billion profit out of it. Strategy is global macro. He's a macro guy, hedge fund manager, and reflexivity is his concepts. He basically says, that his views influences the markets and creates feedback loops. So that's his strategy, global macro with reflexivity. Risk management and psychology, he does bold bets when he's his conviction is high. He bets a lot of money in it. The bold bets he does, and he cut losses quickly. Is legendary adaptable. Position size is very aggressive, when his conviction is high. Highly leveraged also when his conviction is high. But also there's a hedge again to protect, and he will exit the losing positions quickly. Paul Tudor Jones, so his notable wins are he forecasted and profited 125% on the 1987 crash. So he's good at forecasting and accurate forecasting, and also betting on that forecast, and that's where he made a lot of money, 125% during the 1987 crash, around $100 million. Strategy is again macro. So if you're forecasting, mostly it will be macro only. Okay, so strategy would be technical macro, again macro with technical. So he does technical analysis also. So technical macro is his strategy, identifying trends and crash patterns. So that is his strategy, and yeah. So his main thing is forecasting a crash and making money out of it. Similar to Jesse Livermore, who forecasted the earthquake as well as the 1929 crash. Risk management is he is strict stop losses he has, and very small stop losses he has. His risk to reward ratio is very, large risk to reward ratios he has, and he avoids, yeah, whatever losing trade is there, he avoids that trade to escalate, and he quickly cuts it off. Okay, so small risk and large reward, that only he trades. Okay, that's what his risk management is. Strict stop loss he has. No leverage, nothing is being taken. He doesn't use leverage. Psychology discipline is he's totally emotionally disciplined, values losses as educational tools over wins. So he'll try to learn from the losses. So that's what his approach is. Stanley Druckenmiller. So he is also one who is responsible for that, shorting the British pound and making a lot of money. And he was the main guy at George Soros fund. Yeah, and his strategy is macro again, but combined with tactical precision. Okay, performances he made 30% annually over decades with zero losing years. Strategy is macro with tactical precision. So he uses macro again. He uses a mix of fundamental and technical analysis and trades. And he supported Soros in the 1992 pound trade. Risk management is aggressive scaling he does, and quick reversals also on losses. You can imagine, like, he has 30% annually over decades with zero losing years he has achieved. So you can understand his risk management. Psychology, he's confident but always cuts losses, and he adapts to shifting macro landscapes. Then we have Nicholas Darvas. His track record is he made 2.45 million in 18 months. That's a lot of money. Via his box theory, Darvas box is that indicator is made after this Nicholas Darvas himself. So he has this box theory which he developed in the 1950s, and yeah, basically the price, the strategy is that boxes, price is consolidating within that box. Once it breaks the box, it gathers momentum. So that's what is the strategy. The strategy is momentum breakout from price consolidation boxes. That's what it is. Once the price breaks the consolidation box, there will be momentum, and that momentum you will capture. And volume also is used for validation. Okay. Risk management, stop loss is set just below the breakout box. Okay. Discipline is strict adherence to entries and exits, systematic and emotion free. Michael Marcus, he turned 30K into 80 million in 20 years trading futures. So he trades futures. Okay, and 30K to 80 million, that's a lot. Yeah. Okay, so strategy is a blend of fundamental and technical. So he uses something similar to Druckenmiller, a combination of fundamental and technical he uses. Learn from Ed Seikota. Okay. Risk management, never risk more than 5% per trade. Let winners run and cuts of losers short. That's the risk management. Psychology is deep learning focused, discipline with capital control. So these are some of the very famous traders, and their strategies, their risk management, their psychology, their best, the return on investment, or how much profits they have made, that we went through. There will be many others, but these are the main people ChatGPT has given, which we went through today. So summary is Jesse Livermore strategy is momentum and contrarian. This is massive. ROA is massive in bull and bear years. So whenever there is a momentum, the ROA is massive. Risk management is pyramiding, clear stop loss, but emotional swings are there. George Soros macro and reflexivity is his strategy. ROA is 1 billion in single trade. Bold bets, reflexivity mindset, quick loss cut. Paul Tudor Jones macro and technical is his strategy. 125% in 1987 crash. Stops on every trade. Strong psychological discipline. Stanley Druckenmiller, global macro again, and 30% annual over decades, leverage high but mitigated by a quick reversal policy. Nicholas Darvas, momentum box method, 2.45 million in 18 months, technical entries, protective stops. Michael Marcus, futures and forex, 80 million from 30k, less than 5% per trade and let winners run. That's the summary. So key lessons are from Soros and Druckenmiller, strong conviction when it is there, uh, you bet uh, big, and you also look for a hedge and a flexible exit. Jones and Marcus, strict risk control is there, and you'll only trade when the risk and reward, when the risk is less and reward is high. Okay. Trend momentum exploitation, Livermore and Davos, they both did that momentum exploitation. Momentum traders basically. Yeah, and psychological resilience is also, that's a contra trading. Psychological resilience is needed when you do the contra trading. This position sizing discipline also prevents doing. So these are the top traders, their strategies, their psychology, and their you know return on investment or their profits and their risk management. So that's it for today, guys. Thanks everyone. Have a nice day. Bye.